Dear clients, welcome to PhillipCapital's Weekly Market Watch. I'm Chen from Securities Research. Today I'll be sharing with you on Perennial China Retail Trust, PCRT. The presentation will start off by introducing PCRT in brief, followed by investment merits and the valuation, and finally the risks. PCRT is Singapore's first pure-play PRC retail development business trust. It is listed on the main board of SGX on 9th of June 2011 with an IPO price of 0.7 Singapore dollar. PCRT's investment objective is to invest in, own, and develop land, uncompleted development, and income-producing real estate in the PRC. The CEO of PCRT is Mr. Phua Si Guan, the ex-CEO of the Capital Mall Asia and the Capital Mall Trust. Investment merits in PCRT include: firstly, PCRT provides an opportunity to invest into China's long-term consumption and urbanization trends. PCRT's key properties mainly lie in China's major second-tier cities, including Shenyang, the economic and transportation hub of northeast China, Chengdu, the major economic hub of the Midwest China, and Foshan, which shares economic resources with Guangzhou, the economic hub of South China. These cities typically enjoy higher GDP growth than the nation's average and have a stable upward trending per capita disposable income. Secondly, all the 6 core properties are strategically sited at prime locations on cities' expanding edges and transportation nodes, easily accessible by subway lines and the major bus lines. This would be conducive to seizing shopper traffic. Thirdly, leasing activities are expected to improve. Pre-leasing in Foshan Jihua Mall and Chengdu Qingyang Mall, which would commence operations in third quarter and the end of this year respectively, are progressing well. Occupancies in Shenyang properties are expected to improve as the trustee manager strategically negotiates master lease agreement and provides rent-free period to attract potential tenants. PCRT's target distribution of RMB 227 million in financial year 2013 and 2014 are fully covered by the previously negotiated earn-out amount, a source of income support. The targeted amount translated to about 6% dividend yield in the following 2 years. Our 2013 target price for PCRT is Singapore dollar 0.67, equivalent to 5.5 upside potential from the closing price on 7th of May, in addition to an above 6% dividend yield. We give PCRT an accumulate rating. Investment risks include: firstly, a longer than expected gestation period. Most of the properties are not yet stabilized or still under development. Income support from earn-out would expire by the end of 2014. A possible failure to stabilize the property portfolio by then could subject the distributable income to a major decline and decreases investor confidence. Secondly, uncertainty in debt refinancing. A significant portion of PCRT's borrowed debt would be refinanced in financial year 2014 and 2015. A possible unprivileged term would reflect negative on PCRT's earnings. Thirdly, China's economic growth weakens. If economic recovery of China loses momentum, weaker macro picture and slower disposable income growth would weigh on the nation's consumption growth. PCRT, who has all the properties all residing in China and hence lack of diversification, would be fully vulnerable. Last but not least, the translation risk. A possible depreciation of Chinese yuan against Singapore dollar would shrink the portfolio value and haircut dividend income from a Singapore investor's perspective. For more details on PCRT, we recommend our clients to read our PCRT initiation report published on 6th of May. That's all we have for you today. Thank you, and do stay tuned for next week's video.